Alright, so today's video is going to constitute the first video that I put inside of the amplification channel. This channel is going to be with the purpose of amplifying upon the lessons that I have on my private mentorship. In these types of lectures, we're going to go into the specifics of every general video that I post, again, on my private mentorship channel. And we're going to understand how to use these concepts real time. And I'm going to go in the specifics of how a specific trader of mine or a specific student of mine, how can they internalize the lesson that I wanted them to internalize. So this is going to be specifically for a student, but I understand the fact that the problems that occur during the trading process are going to be the same. So that's why I share this with also a general perspective. So I'm going to talk about the things they're going to also understand, the other students that are not the specific target for this or these lessons that are going to come inside of the amplification channel. So today we're going to talk about the January week 3 amplification, which is a stop loss management during the CPI week of January 2025. We're going to also talk about the accumulation, manipulation, distribution concept. We're going to go in depth about how to use the AMD for the PM session and more specifically for the last hour trading, and how to correlate the 15-minute chart with the daily chart and how to understand how to use the AMD. So I'm going to talk about Martino's POV or POV. These are his charts. This is his trading. I'm going to give you his perspective, what he thought about the session, what he did in terms of his premise, and how I lectured him upon the lesson that I wanted to emphasize. So this is what he wrote down. Wednesday's PM session, history of the trade. So for this trade, I'm going to read like he sent to me. So for this trade, I had a bearish premise because the market has been going high strongly and we had the liquidity pool above. I'm going to show you the chart. So when the market took the buy side liquidity, we had a market structure shift. For the PDRA, we had two value gaps and a breaker, and I diced to take a position during the 1450 to 1510 macro. And now we can see the market continue going higher, checking me out. And after the market made the model again, after the market made the model again, but this time during the 1545 macro, I didn't take a position since I already took one. And this is the chart that he sent me. So basically what he did was, and this is between the 1450 to 1510 macro. What we saw here was the market taking on a high, making this a balanced price range dealing range. What I understand is that this is a higher time for liquidity pool, so 15-minute chart liquidity pool, in which went above, went higher, and his premise was that the market shifted here, went lower, and then he saw this as a market structure shift, going lower and continuing into this level of sell side. He entered a shorting position with a stop loss above this supposed breakaway gap. Market continued lower, but he got stopped out at this specific candlestick. And I'm going to explain why this happened throughout the 1450 and 1510 and why the market didn't go as he anticipated it to go and why it started running towards the wanted or desired liquidity pool inside of the next macro and not this specific macro. So this is my explanation. So as you can see, I have the same liquidity pool annotated in a 15-minute chart. This is the AM session buy side liquidity pool, which also Martino had annotated. This is a liquidity pool that I would aim for inside of the last hour trading, which is between 15 a.m. ET, so Eastern time, or New York time, until 16:30. What I wrote down here is the last hour trading high of the day creation model. What this basically means is that according to the daily accumulation, manipulation, and distribution, what we saw was the market opening on the London session according to time. So the New York midnight opening price. For this specific day, we saw the market opening, creating the low of the day, having a distribution to the upside between the AM session or inside of the AM session and the PM session. And therefore, what I wanted Martino to understand was that the last hour trading is specifically, or more times than not, going to create this type of scenario right here. So we want to see the high of the day being created, the high of the AMD being created on the PM session, which is between 13:30 and 15, or even 13:30 to 16:30, depending on the underlying market characteristics and depending on the specific context. But this time I was anticipating the market to create this high and then to retrace back into a daily range, which is exactly this scenario right here. But the reason why I've stated LHOT, this stands for the last hour trading. And when I'm talking about the last hour trading, I'm talking specifically about the time period between 15 ET and 16:30. The reason being is because this session's characteristic is for the market to return back into an obvious counter liquidity pool that has been occurring throughout the day to form this exact characteristic linked to the daily chart. So we saw the market going higher for the PM session. So therefore, when 15 occurs, when the 15 o'clock ET starts, this scenario is exactly what I'm looking for. And what is the previous session? The PM session between 13:30 and 15. So one liquidity pool that I've identified, of course, we can also take this one. We can take this fair value gap. We can take this one, and I would take this as my dealing range. But it doesn't matter because we did not go into a discount. But basically, what I wanted Martina to understand was the specific of the last hour trading characteristic. And here is the related 1 minute chart according to that 15-minute chart. So these are linked. This is the last hour trading that I was talking about in the previous 15-minute chart. And this is a more specific crude depiction of what I was anticipating throughout this 15 to 16:30. What I wrote here is when I'm looking at the last hour trading, or if I am a last hour trading trader, I will ask myself the following. What did PM session and AM session do throughout the day? Okay, the market went higher. So what is the obvious liquidity pool remaining in the last hour trading? And what is the last hour trading? Again, between 15 and 16:30. So when am I going to expect the market to reverse back into the old levels of sell side? Between 15 and 16:30. So this is the specific time period. That's the number one thing I would see as a mistake in Martino's trade execution when he tried to go short inside of this fair value gap, placing his stop above this breakaway gap. It was not the specific time period. We were still into the ongoing rally of the PM session to create the high of the day. Also, what I wrote down inside of Martino's explanation was, how do we know once we are inside of the last hour trading, how do we know that the market is going to reverse? not only correlated to time. What I did here was, because we have this breaker, and this breaker is the responsible PD rate that sent price lower back into this fair value gap, into this discount fair value gap, because this is what this really was, the market retracing back into a discount. Because this one was responsible for this movement lower, I projected it to the upside, and what I did is I measured how much higher will the market go above this PM session buy side. And what was the obvious and the opposing liquidity pool of this PM session buy side? The PM session sell side and this PM session sell side, because these are relative equal lows. And if we go below this, we're going to also go below this. And if we're going to go below this, we're definitely going to go below this, because these are relative equal lows. So what I did is I applied the fib and I projected this breaker standard deviations, which are going to be seen as the following: the minus 0.5, the minus 1, minus 1.5, minus 2, minus 2.5, and minus 3, and so on and so forth. What we saw between the PM session buy side and the minus 0.5 was, if I'm looking at this level and at this level, between them, there's the 50% between these levels. We can see that the market closed below that level until we broke out of it. Next one is the minus 0.5 and the minus 1. We can see the market closing and hitting the 50% between the next, where we closed at the 75%. So I would want to see the market open, use that level and go higher. And what I'm doing here, without going into the detail, because that's just going to be like, okay, the market closed here, so we have to do this. This is exactly what I do when I have these levels here. I take the 50% between them, the 25, if there is a higher time frame level, I will also take the 25, the 50%, the 75%, and so on. What I do here is I constantly measure how the market delivers relative to these levels. So the minus 2, okay, the market closed above it. We also went to the 2.5. And we can see here that the market went into the minus 3, creating the high of the day in the minus 3 breaker standard deviation. We never closed above the 50% BT. And then what we did is we took 1, 2, and then 3. We can name this as a PD array. So we took 3 PD arrays. We were already anticipating the market because of the time period to reverse back into the PM session sell side. So this would constitute our market structure shift. But what I want you to understand is that I already know that I have to look for these signatures. I already anticipate the market to deliver this specific scenario. And on a 1-minute chart and on a 15-minute chart, I'm just looking for signs that the market is going to indeed do that. Also, these levels, once we're going to go to the downside, can be used as a means of measuring whether the narrative is correct or is weak in this case or not. For instance, once the market creates the expansion, so this is a retracement, we shifted. This is a market reversal, retracement, expansion, algorithmic phases. Again, retracement back into a what? To a SIBI, expanding. What do I use? Auto blocks, boom, lower, coming back, going to the downside. But what I do here with these breaker standard deviations is I see that the market closed below them. So I want to see this now being used as a bearish PD array. This would be a balanced price range dealing range, because we have this intermediate term high. This is a 15-minute inversion gap. Market comes back into this. We failed to take these lows, so these are engineering levels of sell side, and then we go below them at a specific time period of 15:45. And while we are inside of the last hour trading, I want to state the fact that there are more macros inside of the last hour trading. So we have the 1450 to 1510. And inside of the last hour trading, we also have a macro that starts at 1515, which is the exact time in which the market pulls to the upside. And it is between 15:15 and 15:45, exactly when this movement expires, right here. So when can we anticipate the market to create this already anticipated reversal? Between 15:15 and 15:45. And this is exactly what I wrote. These are my annotations. What I stated was the exact thing that I was talking about, which is to internalize the daily candlestick and the current state of the daily bar of 3 with the current time of day, which is exactly this. So we had a PM session rally, and I was anticipating this to occur throughout the last hour of trading. So this is how the daily candlestick will look like. If you're going into your charts, you're going to see that this is exactly how it looks like. So this is what we were anticipating according to the daily chart. I stated the fact that he has to think throughout the session like, what did we do inside of the AM session? Well, we expanded higher. Okay, what did we do inside of the PM session? We expanded higher and created a distribution. Therefore, what do I anticipate for the last hour in trading based on its characteristics? Now I've stated that I wanted to see an opposing run on the previous session sell side. When do I know the movement starts? Time period between 15 and 15:45. We had a 50-minute chart swing high along the constant measurement of how the breaker standard deviations or Falcon Point standard deviation performed, which are these. This is the breaker standard deviation, and I've stated these because we can also project this, and I bet that the minus 0.5 level is actually going to be here. And this is a 50-minute swing high that we've created, stating that we're going to have a short-term retracement on a 15-minute chart. So based on a 15-minute chart, this can be named as a retracement, but instead of a 1-minute chart, it is going to be seen as an expansion to the downside. I've also stated that you could have projected the range also, but I prefer breakers. See how the market gave you signs that it will continue inside of the next breaker standard deviation, which is exactly what I've stated throughout these candlesticks. See how the market never closed above the 50% between the minus 2.5 and minus 3, meaning that we can potentially see the start of a reversal, which is this here. Swing high, market went below this swing low, created this intermediate term high. So this I wanted to see as a point of potential reversal. If we're going to reverse, then I want to see the market form a specific market structure shift by going below the low that sent price higher. This is the one, and I've also stated that this correlates with my underlying 3P arrays that I want to see the market take out. And moving on into Thursday's trading. So again, I'm going to state Martino's POV, and then I'm going to give you my explanation. Thursday's PM session. So for this trade, I had a bullish mindset. Again, this is Martino. We had the lunch, sell side liquidity, and the AM sell side liquidity being taken. After that, we had the market making a market structure shift. I took a position during the 1350 to 410 macro, and I had my 3P arrays. That's the fair value gap and the one order block. And after taking the trade, the market took me down, and right after it went on the way that I wanted it to go. He also stated the fact that he saw me take an execution here, but this was more riskier. I'm going to explain why I took this position here and why I chose this fair value gap as my PDRA, why I wasn't scared, or how I measured where to put my stop loss and what would happen if my stop loss was about to be taken. But basically, this is what we had as sell side liquidity, or this is what he had as sell side liquidity. This is what he internalized as a market structure shift. These are his PDRAs here. This is his target, and I'm now going to explain how I see this chart. So this is going to be my explanation. For Thursday's trading, I was anticipating higher prices as well that would send us higher for today, but later on I understood that said daily candlestick would be used as the candlestick that goes back into an inversion gap for the market to later on expand higher throughout Friday. So I would, first of all, what I anticipated was, and I was wrong. I was profitable but wrong. But let me just tell you what I was anticipating. So I was anticipating the PM session of this specific Thursday to be sent higher with speed. But later on, I discovered that Thursday's PM session was used for the sole purpose of going back into an inversion gap on a daily chart so that Friday's trading will expand higher above it. So this day was a day in which I was wrong, but yet I was profitable, which is why I always preach that that is the main objective, if not the only objective. And if I had the right understanding of what the daily objective was, then I would have obviously waited for the last hour trading to attack the previous PM session liquidity. So this is what I saw from my underlying trade. Market went back below Thursday's AM and lunch sell side liquidity pools. And what I was anticipating was for the market to take on this high, and also these highs on Thursday, but we never did. Therefore, we did that on Friday, but I was anticipating this so that we would have an up close candlestick for Thursday's trading, for Thursday's daily candlestick. We never saw that, but yet I was profitable, but not correct. But basically, what we saw was the market delivering to the downside, taking on Thursday's AM session liquidity and lunch session liquidity. And this setup that I took, that also Martino took, was a retracement based setup, retracing back into the 15-minute premium CB. So this was what our underlying 1-minute idea was based on. I've also stated the fact that I would prefer, if I had the right daily objective, if I understood the fact that the market would go down so we can go up on Friday. If I had that, then I would have chosen the last hour trading for my trade premise. And after we closed above the CB, I knew the fact that this was about to be an intermediate term high. And then once the market retraced back into a specific macro, I would have used this order block, framing my 1-minute shift. Then I would attack this PM session sell side liquidity. So this is my 1-minute chart. You can see that this is my trading execution right here between the 1350 to 1410 macro. This red shaded line right here is the lunch sell side and the AM session sell side. And what I took is I took this fair value gap here as my entry, or this fair value gap formation rather, as my entry. And I placed my stop loss below the mean threshold of this order block. The reason being is if we were to close below the mean threshold of this order block, then I would have wanted to be out because I would be more probable to be wrong than to be right, and I would want to be out. So my stop loss is not really my enemy. My stop loss is really my friend because it saves me from a potential bigger loss that I would incur if I would not have said stop loss. What do I mean by this? If we would have saw the market closing below the mean threshold here, then it would mean that the market would have went into the lower quadrant of this order block, and it would later be followed by a big expansion to the downside to continue the market movement lower inside of the PM session of trading. And if that would have happened and I would not have any degree of a stop loss, then the market would just crush me to bits. So my stop was here, my buy was here, and I was targeting, I did not have this level, but I was targeting this or a higher liquidity pool to be taken. My exit was here, because I saw the market consolidating inside of a PWA more than I've wanted, and I exited manually without any degree of a target being hit. Perhaps this premium CB could have been taken as a means of a target, and I am actually concerned with the trade. But the trade that I want to discuss right now is the trade that Martino would have actually taken, and the correct trade that I would frame for him. So, our trading states the fact that we have to have some form of a liquidity pool from a previous session to be taken. This is the lunch session sell side, again, the AM session sell side, and we've had that taken. The next thing that we want to see after this is taken, we want to see a 1350 to 1410 macro shift in this case, or we want to see a macro market structure shift. We've had the market coming back into the mean threshold of this, repricing higher. This is going to constitute our market structure shift. And we can see that the market fell short of that 15-minute premium CB that I had as my session target or for my movement target. So what I would do if I was Martino is, okay, I saw this. What I'm doing is I'm anticipating the market to come back into a discount now. Did we hit our 50-minute CB low? No. So this is the low that's in price higher, creating this market structure shift. Once we see 1, 2, and then later on 3, or you can also use this one, this is how I use it. 1, the first P array, we failed that. 2 is going to be this fair value gap, and then the third is going to be this BISI. This was my third P array, and this was also reasonable discount retracement. So this was the internalizing thought that I've had if I was Martino, or I would have had if I was Martino, if I was trading this model. If the market closes below this BISI or the BISI, I would want to be out, which would constitute that my stop loss would be below the consequent encroachment of the breaker, or not the breaker, but the breakaway gap. This is the breakaway gap. This would be also a balanced price range dealing range, because the sole purpose of this retracement was for the market to rebalance this BISI. We made this BISI efficient and then we left it. So this is a BISI which is now balanced after we go above a swing high. So therefore I would not want to see a deep retracement back into this balanced price range dealing range. Therefore I would want this to be open, and the reason why I've stated the fact that I would want to see the stop loss being below the consequent encroachment of the breakaway gap is because we can see the market retracing back into it, but I would not want to see the market close below the fair value gap high or the consequent encroachment of said fair value gap. So my stop loss would have been here, and my entry would have been at the fair value gap high, fair value gap 50%, 25%, or whatever you choose as an entry. So let's assume that we have a position now. Instead of this BISI, our stop is here, and we're targeting, let's just say that we have multiple contracts on for the sake of stop loss management rule sets or stop loss management amplification. What we're going to target for this full take profit is going to be this CB's high. So once the market creates a swing low here, leaves, what I do is, first of all, I measure my implied dealing range, which is going to be from this low, the low in which I entered, and my target, which is going to be this fair value gap high. I will also have my implied dealing range, but let's talk about the stop management. Once the market closes above the 50% of this inversion gap, then I would want to see the market close above it to create it as a means of an inversion gap, which would mean that this failed. This is also a sell stop rate. So once we go above the swing high, we rebalance this BISI also. So we would not want to see the market coming back into it. Market goes back a little bit into it. We can see how the market now closes above the BC high from a swing low. Market goes higher, immediate rebalance here. Market goes higher again. I'm looking at this as a means of a mitigation block. Fair value gap high, and then we go above this, naming it as a balanced price range dealing range once more because we made this fair value gap balanced. Market goes back, and then when it retraces like this, what I do is I constantly measure, and I forgot to tell you that when the market reaches the fair value gap low, that's when I'm going to put my stop at break even for the purpose of the fact that we made this retracement here. So therefore, exactly as I've stated, this is now a balanced price range or a balanced BC. So I would not want to see the price go back into it. So my stop loss is now break even. Once the market hits the CB low, market goes back, and I constantly measure 1 P array, 2 P array. We see the market showing signs of strength. Market goes higher. This is a balanced BC once again. This is also a balanced price range dealing range. And the market also hits the lower quadrant of this CB. So what does this tell me? This tells me that I'm going to take another partial. So I'm going to take my first partial at the fair value gap low, second partial at the lower quadrant, third partial at the consequent encroachment, and I would leave the trade towards the fair value gap high. You can see the market creating this balanced price range dealing range. And what I do again is I constantly measure 1, 2, 3 P arrays. Market goes higher, fails to take on this high. Market closes below this, and this is my last P array. I'm also looking at the mean threshold. I can see the fact that the market went into the mean threshold, never closed below it. We failed to reach once more the BC high. We instead just reached into the inversion gap high, and thereon started another expansion between the 1450 and 1510 macro specific time period. And what I do here is I internalize this as a retracement, sell stop rate, inversion gap, closing above the 50% of the inversion gap, using the 50% or even falling short of it, which is a sign of strength. Market closes higher than or at the lower quadrant of the CB, forming a swing low. So what I want to see throughout this movement is for the market to create higher prices, and I want to see the market expand higher. Also a breakaway gap, and when the market reaches the 25% or the lower quadrant, that is when I'm going to trail my stop loss below this low and into the lower quadrant of this inversion gap, because this is a balanced price range dealing range, and I would never want to see this swing low being taken. And if it is, again, this is my third P array, I would want to be out. Market continues higher, sign of strength, stays a little bit at the lower quadrant, uses this breaker here, creates another breakaway gap, and then we expand higher above it, which means that we're going to go into the lower quadrant. This is what we do. We take another partial. And here, what I've explained to Martino is that once we do this, then what I'm going to do is I'm going to become aggressive with my stop loss management, because I'm already inside of the take profit, quote unquote, zone, or the take profit objective area, or PDRA, or a specific PDRA, or specific level. So from here, when the market reaches this here, I'm going to be very aggressive with my stop, and I'm going to place it at the lower quadrant or even below the lower quadrant of this, wanting to see my final exit at the fair value gap high. We can also correlate this with the fact that this should be right now balanced price range dealing range. So if the market reaches back into this lower quadrant, then I would want to be out, because we should never see price going back into this point until we reach our target. And if we do, again, we want to be out. Also, fair value gap, and yet another. So again, you can see how this correlates with the 3P array rule set. And you can also see right now how I constantly measure. Moving on, market comes back and fails to reach the constant encroachment, we hit the lower quadrant, the upper quadrant of this SIBI. We leave this open, and then the market hits our objective. I mean, it hits it here. But what if we were aiming for something higher? Then again, I would place my stop even higher at the constant encroachment of this SIBI. My PD rates would be the following: fair value gap, order block mean threshold, and then order block mean threshold, or even this fair value gap. So I would have it here. And you can see that the market indeed took us out between 15.15 and 15.45 and even 16 when the underlying market reversal starts it. So you can see effective stop loss management and how we manage our stop when we have multiple contracts on, how we manage our positions when we have one singular contract with the break even, and I'm going to leave it there. But basically, I wanted you to understand this type of advanced stop loss management into the final part of our trade. So again, 1, 2, 3. If the market goes and closes below this right here, I would be out. This is the same thing that I've said inside of my explanation, so now I'm going to read it again. You can pause it and you can screenshot it, or you can write it down. Same thing here. This was the lecture on effective stop loss management for January week 3, 2025. This was the first lecture inside of my amplification channel, and I'll see you next time.